Hello everyone and welcome to the special show, The Big Sell-Off. I'm Avanne, Dubash with Ayesha, Faridi and Ayesha. What a tumultuous day we had, and largely owing to the fact that we were piggybacking on those global cues with the escalating tensions between Iran and the US. We saw an absolute sell-off kick in, a bloodbath on the Lal Street, if you will. In fact, the fact that crude oil prices is well flared up and expectations are rife that it's not going to be the most promising of earnings season, we saw the free fall play out on the Lal Street. So just a few days ago, where we were tom-tomming about how there has been a divergence between the macros and the markets, we were at least perched close to those all-time highs. But today, it seems like there has been a complete reversal in the situation. Take a look at the screens. It's been nothing but red across the board. No sector was spared the carnage. 12,000 nowhere to be seen as we wrapped up sub that level. For the Sensex, after seeing an 800-point nosedive during intraday trade, we wrapped up 787 points lower. The broader end of the market as well, seeing underperformance, and no sector, Ayesha, was in the green today.
Oh yeah, absolutely. The only spots of green perhaps were the IT index. The defensive nature of the market clearly now playing out with the kind of move that you've seen in the dollar-rupee parity as well. So perhaps those were the only spots of green. Aside of that, they were all falling like nine pins. I haven't seen this kind of a dismal market breadth in a while. If I just look at the F&O universe, there were only 7 stocks which were standing to the advances with a good 140 or to the declines on a closing basis. In fact, we've even breached that 12K mark, a level we haven't breached since almost the 13th of December. So while in the coming, even technically, we've managed to breach the 50 DMA on the Nifty, and this is the telling sign. Yes, geopolitical tensions are the ones which are weighing down on us. You've got a spike coming in on not just the India VIX, but CBOE VIX as well, which on Friday alone jumped up by about 14%. And the way the European markets kickstarted trade in today's session, or for that matter, the way Asia panned out, it doesn't really seem that this situation is going to be arrested anytime soon. It seems that there is more pain. The global markets, once they've come back from the New Year holiday with all these geopolitical tensions between the US and Iran doing the rounds, in a fresh threat that US has issued to both Iraq as well as Iran, that this weakness in the markets is going to be subsiding anytime soon. And look what it's doing to some of the safer haven assets. Look at what's happening to gold. Look at what's happening to other precious metals as well. Gold is already at a 6-year high. Silver as well, fast catching up with that move. You've got platinum, which is sitting at a record high for itself. Crude, of course, has been on the spiral up, and it's anyone's guess as to where this unrest is going to really subside. Before we take it across to our market experts, let's bring on board Ajay from our research desk to try and really summarize all the factors behind the market weakness across the globe right now.
Not only in the market falling off the cliff, but the VIX, which is the volatility index or the risk gauge, has shot up pretty sharply. And yes, the trigger, of course, is that there's a global risk-off which has gripped the equities worldwide, and India is participating in it. But if you look deeper, it's not only that. We had rallied quite a lot in the last couple of weeks and months, especially on the benchmarks, and the broader market had just started to play catch-up. But all of that, again, is getting reversed because crude oil prices have spiked up 5%. And this is likely to put pressure on India's fisc. Remember, we are already ahead of the budget, and the way the investment is lagging behind BPCL, Air India, etc. And there is already pressure on the fisc. In fact, the market wants the government to accept that there's pressure on the fisc, and it will ease out the bond yields. So that is one big concern. Not only that, we are in the earnings week. The third quarter earnings season is likely to start from Friday's Infosys numbers, and the early indication which are getting in is very patchy. Look at Titan, then there is a Marico in front of it. So Q3 earnings season is also likely to be very sluggish, and that is also making markets jittery. Valuations had already run up quite a lot, and geopolitical triggers provided a reason for investors to book profits and traders to start shorting the market. So all these things brought together is leading to this big fall which we are looking at right now in the markets.
Okay, thanks for that, Ajay. Sudip Bandyopadhyay joining in. We also have Kunal Bothra on the charts and Jai Bala of Cash the Chaos with us on the phone line. Good to have you all, gentlemen. Sudip, let's start off with the situation as it presents itself. A number of factors that are leading to this. but largely this kind of a gash has been owing to the geopolitical jitters across the globe. Do you sense that this now opens the door for further cuts for the markets, given that expectations are rife that it's not going to be the most promising of quarterly earnings for us?
Right. I think the Indian markets had moved up quite a bit, and there was definitely some correction in the offing. This geopolitical tension provided that kind of window, and we've seen sharp corrections today. Also, remember the fact that this geopolitical tension directly hits into India's fist. The oil prices have already shot up, and if the tension persists, it may go up even further, which doesn't at all augur well for Indian markets, economy, and the fisc. So obviously there is going to be incremental pressure. The risk-off mood of the global investor, which is getting depicted across the globe, and we'll have to wait for US to open, and we'll probably find out more about this mood later when US opens. But the fact remains that Indian markets have shown the initial crack, and further cracks may be expected depending on the global mood, unless the escalation somehow gets contained very, very soon.
Kunal, to you then on the charts, because today we've reached the 12K mark, like you said, after mid-December. We're sub the 50 DMA, and this is the Nifty movement alone. I'm not even touching upon the market breadth. What's in store for us? Because it clearly seems that this weakness is not going to subside anytime soon.
Absolutely, Ayesha, and there should be more pain for the indices, going forward as well. Now, the data which or the event which transpired happened on Friday, before closing, before the market opened for us. Friday, the Nifty was down, I think, 55 or 58 points only. So, the expectation for the markets were that maybe this event could be one-off event, and it could probably be not have a major repercussion on the markets globally. But then what transpired today is when the markets opened up on the negative side, there was a whole lot of panic which happened on the overall market scenario. There was good amount of long unwinding which happened for most of these large cap names. I think that is where the selling pressure got more aggravated, because then you had large cap names which are bleeding, names like ICICI Bank, HDFC Bank. So none of the large cap ones could probably support or hold the markets. We've broken below that 50-day moving average, which is a very crucial and important indicator. Look at the behavior of the markets on 50-day moving average across the last, I think, 1.5 or 2 years, and it's been acting as a consistent level of indication of trend reversals or trend change as well. So this break below 50-day moving average could be crucial. Now the 12,000 mark, or below the 12,000 mark, the next level of support for Nifty is at 11,800, which I believe is a very important and a crucial support for Nifty.
Jai Bala, hi, afternoon. We were cribbing about those 15-20 stocks doing the legwork and keeping us at that all-time high, and now comes this global event. We're clearly also somewhere falling under our own weight, at least about those 15-20 stocks. But the point now is, what is it that you do with this weakness? Do you already start buying into it, or do you wait for the weakness to settle down somewhere?
Good evening, Ayesha. No, I have been saying that, since October, that this high is not something to be played with. It's you should be participating, but with a trader's mentality, not with an investor's mentality, and that still remains the case. So basically, the trailing stops for the Nifty was about 12,100, so that's been triggered. The major support, like the previous speakers pointed out, it's at 11,800. I think that will go in a few days' time. I think the Nifty is setting in for a much deeper correction, lasting several weeks. So, as an investor and medium-term trader, you should be taking profits if you had participated from the, September lows. And if you are a short-term trader, you should be trying to short this market on every rise.
Okay, what about your view on the Nifty Bank then, Jay, in terms of the kind of deep gash that we've witnessed after what has panned out already in 2019? What is it that you foresee for the entire banking sector, given its heavy weightage, including the likes of, some of the NBFCs, insurance, and of course the private bank bellwethers?
Yeah, the only bank that's still not broken major support is from the ICICI, and that's major support for that comes at about 505. If that's broken, I think the entire sector is poised for a much deeper fall. And the major support for the banking index comes at about 31,000. So watch out for it. Probably that'll happen in sync with break of ICICI's major support trends. At the moment, HDFC Bank, Kotak Bank, they are all coming off, a completed cycle from the 2019 lows. So basically, they are due for correcting the entire move, at least 50% of the 2019 to the all-time highs they made from the 2019 low. So the banking index is actually the one that's going to be dragging the overall market. So more vulnerability is there, and the PSU SBI heavyweight is actually looking a little more precarious than other names here.
Right. Okay. Sudip, wanted your thoughts as well, because the bigger casualty today, like Avanne rightly highlighted, was the banks and especially the PSBs. Now, the concern with the creme de la creme was also that, reflation is something that the market is not really pricing in. These stocks have given you fabulous returns. All of the year gone by, they continue to trade at high PE multiples. So some of them are going to fall under their own weight. We've already seen that play out with names like an HDFC Bank or for that matter, financials like Bajaj Finance. Would you say if someone has a short-term time frame, it is wise to profit take from some of these names perhaps?
Ayesha, if it's a very short-term time frame somebody has, then I think it definitely will be wiser to kind of selectively book profit. Of course, you have to keep watching the market, and when there is an opportunity, you can book profits. I don't see these stocks, moving very quickly to different higher levels, in a hurry. So you can book profits. But overall, banking and financial services space, we continue to remain positive. Remember what is happening today and what's going to happen for the next few days is on the back of a geopolitical unusual event. We cannot predict these kind of events. What we can predict is, I think the banking and financial services sector is coming out of a major correction. And I think we have seen a part of that correction play out in the last calendar year. Another part of the correction will definitely get played out in 2020. Now, whether HDFC Bank and Kotak banks of the world will keep moving up or not, my answer is no. They will not give you that kind of growth what they had given in 2018 and 19. What will move up and what will give you growth in 2020 will probably be the corporate-facing banks like ICICI Bank, Axis Bank, and SBI. Even from current levels, leave aside this geopolitical tension-related correction, they will, over a period of time, 6 to 12 months, give the investor handsome returns. So whether they should go and buy today, tomorrow, day after, my thought will be they should wait and watch. They should not jump into the market right now. Let's see where things settle. Even if you're not able to buy at the bottom, doesn't matter. Probably buy when the market starts moving up.
Kunal, we were chatting about this while the trade was on today, that banks will face the heat, and rightly so they did today as well. Where would you find fresh shorting opportunities within banks purely?
So I think the PSU banking pack, of course, would be on top of the list in terms of taking fresh shots. And I think other than SBI, which I believe is still a stronger stock out of the lot, I think Canara Bank, PNB, these would be the key names. Bank of India, which is now not in FNO, I think even that stock could show signs of weakness. And look at the price performance of many of these other tier 2 PSU banking pack. They've been failing to even cross the 200-day moving average in the best of the market trends as well in the last 2-3 months. I think that's one of the reasons why I believe that on first signs of weakness or volatility coming back, these are the stocks which could try and correct further. Then you come back to those private sector banks, and I believe HDFC Bank, could be one of the top candidates for fresh shorting. IndusInd Bank also had a feeble rally. The stock broke its 200-day moving average. So there could be a mean reversion happening for names like HDFC Bank, ICICI Bank as well. And there could be more trend reversal which could happen for IndusInd Bank. So, one has to try and pick and choose the kind of risk criteria one is looking at. If you're looking at more short-term, chart patterns and more, stable beta or relatively moderate beta stocks, then you can probably look at HDFC Bank and ICICI Bank as good shorting candidates. But if you're looking at more, high beta stocks and more short-term oriented trades, then you can look at names like IndusInd Bank or the PSU banking lot.
Okay, that's where Kunal identifies further shorting opportunities. But just on the subject of the extent of escalation between the tensions between US as well as Iran, let's take it across to Mubina. she's been monitoring all the geopolitical news of late to try and really assess how deep could this problem really go on, and more importantly, Mubina, how stretched could it be?
This is not the first time that the US and Iran have come at loggerheads, but this time around it actually comes down to ego, right? Because you're talking about the United States going into the Middle Eastern region and assassinating the Quds Force leader, that's Soleimani, and that in turn has led to fanning of tensions between the two countries. This started off with Iran saying that it no longer considers itself bound by the 2015 nuclear deal negotiated with the United States and the other world powers, adding also that it has a score to settle with the United States. Now, the United States in turn has said that there's a heightened risk of military attacks, missile attacks near military bases and energy facilities in Saudi Arabia, perhaps as a reminder of what happened back in September 2019 when the Aramco facilities were sort of attacked. It was a big disruption to oil facilities, but Saudi was able to recuperate very smartly. Not just that, the US has also warned Iran not to take any action against this assassination of the Quds Force leader, that's Major Soleimani. Now, in turn, this is something that has led to fears with respect to disruption of oil. Like I said, it's not the first time that the US and Iran have come at loggerheads, especially post the sanctions being imposed. Together, Iran and Iraq contributed around 6.7 million barrels per day in terms of oil output last month. That's at risk. So crude prices naturally because of that went to $70 per barrel. But again, you know, you have analysts and brokerage firms like Goldman saying that unless there's actually a disruption, I think we'll just wait and watch, and in all probability prices will be capped for crude. But when it comes to gold, I suppose investors did not hesitate in just buying into safe havens like, the precious metal, $50, $90 per ounce. That's a huge uptick. And back home as well in India, we had to see 40,000 for gold on the charts. This is one of the most escalated tensions geopolitically that we have seen in a very long time. And hence you could see some safe haven buying coming in.
Okay, thanks very much for giving us those details. It is certainly a very precarious situation as things stand. Jay, before we let you go, I wanted to get in your take as to what your outlook is, given that the markets were in the hands of a very few stocks that had ridden high, the likes of RIL, Kotak, ICICI Bank, etc. What exactly is the view on some of these marquee names as they've cracked? Is there an opportunity?
Opportunity to short, probably. I've been saying that portfolio investors should not be taking a medium-term, long-term view on the markets even after the corporation tax cut. That was an opportunity to trade rather than invest. So that that has probably come to an end, and we are looking at two possibilities for these corrections. And the first is the market retraces all the way to the place where the corporation tax cut began. So it's about 10,600 on the Nifty. The second is a much deeper correction. So it all depends on how the markets see a follow through to today's selling. If you see further follow through, which is sharp, and I would even extend the possibility of the market going well below 10,600. But if the market was to play out slowly, then and chop around without going much lower, we might have to work with a slightly higher target for the correction. So when it comes to RIL, and I think it's probably completed a major top at 1618, and it's correcting, and marking names like HDFC Bank and other frontline like Bajaj Twins, I think they might have completed an important cycle, and there might be big downsides possible for Bajaj Twins. So because they have completed a major cycle, I think there's even a 20% drop potential for these names.
Hey, Jai Bala, good to have you on the show. Thanks for joining in. As always, let's also bring on board Manish Singh, Chief Investment Officer at Crossbridge Capital, joining us on the show right now. Manish, hi, afternoon. Just assessing the damage across world markets. As an investor, how do you deal with situations like these? Because you don't know how long it's going to last. You don't know the extent of the damage. What's really going to come out of this tussle between US and Iran?
Yes, so good afternoon. And my view is that we have to look at the money in the sense that look at what the futures are doing and what the oil market is. My personal belief is that there's plenty of oil supply in this world. So one should not be concerned about oil price really hiking up. And the only scenario in which oil price really hikes up if there's destruction of capacity. And when you talk about destruction of capacity, you talk about will there be destruction of capacity in Saudi Arabia or in Iraq. These are two basically main producers in that part of the world, and I just do not see that happening. So my personal view is that you have had some spike in oil price. It's going to be a bit like what happened last year when part of Saudi capacity was destroyed and it was built up very quickly. I just do not see an incentive for Iran to get into an all-out conflict with the U.S. They are no match to having a conflict with the U.S. And these things happen only when two sides feel that they are equal and they can win out of it. People keep talking about World War I. The World War I went on because the Germans, the French, and the Brits, they all thought they can be better than each other, and they can have a fair fight. That's not the scenario. So I just do not see, A, there's plenty of oil supply, and B, I don't think that the Iranians are any match, and they're not going to do anything stupid, which brings even more trouble for them. So if I use that as a base scenario, my only things that I'm looking at are Fed. Fed has already done a QE without calling it a QE, and they continue to do that. And that just tells me that barring the noise, I would think that the market will stay where it is and continue to ratchet up slowly higher. Emerging market will have its own issues, but I don't think it will be related to oil. It will be their own domestic GDP or growth issues, but not oil-related ones.
Sure. But do you tactically reposition your portfolio, Manish, in lieu of this event? Do you now increase allocation to mid and small caps, which have underperformed for almost the last 3 years, as opposed to those 15-odd Nifty names, which have given you that 13% return in the year gone by? But now it seems that, everything seems to be going against them, at least as of now, because the valuations clearly don't support the growth multiples that they are going to post in the near term.
I mean, personally, for me, when I invest, my stocks are more, my investments are more in large cap, so not in small and mid cap. So I have not looked at that sector rotation. But in terms of allocation, my allocation is underweight emerging markets for structural reasons. In terms of what we saw last year, U.S. economy growth being okay, but not as roaring as it was in the past. I still keep a U.S. overweight position and emerging market underweight position. And given what has happened or what is happening in Middle East now, I'm not looking to change my view immediately. And having said that, I'm not overly concerned, as I said right at the beginning. But I'm not looking to make any changes to my allocation. I continue to remain dollar positive, U.S. overweight, and emerging market underweight. And India, of course, you will know this yourself, that there are lots of issues going on in India at this time. But growth-wise, it's still hitting a 6% level. The finance minister is making a lot of changes, and she's making new announcements. Hopefully, those things are going to help. Growth-wise, U.S.-wise, Fed is competitive. So you will get 2%, 2.5% U.S. growth, so that should help. So there's no concern, in my opinion, to panic or be a seller. To your question about the rotating from large cap to small cap, I haven't looked into it, so I cannot answer. But my views on equities are positive.
Just, Manish, to pick on that point about your view on US as well as the way the dollar is going to pan out, would you say that it would be prudent perhaps to stay put within IT? Because you can immediately, even in today's session, you saw that shift to the defensives, and IT was the only one which which managed to withstand today's storm.
I would agree with that. I think that, it's very easy to get caught in what's happening at the macro level, and that's what the whole Middle East agenda is, and it has just taken over the newswire. One should just look at what are the basics of what is the building block. And there, oil, U.S. economy, growth, those things are key thing to look at. I mean, you will remember whole of last year, a lot of people have been bearish on equities, saying U.S. will have a recession, and it was one of the most hated rally all throughout the year, and people start joining in towards the end of the year. I just do not see a U.S. recession. I just see U.S. Fed being very accommodative, and if anything, more so given what's happening in the Middle East. So that will continue to help the U.S. economy, and 2.5% U.S. growth is going to be very useful for the entire world. You come down to Eurozone in Europe. I mean, there is not going to be any more rate cut or negative rates, and rather they are going to help the economy. If you look at ECB conference, for every question, the response is, we are having a strategic review. So you're not going to think any new news coming from ECB. In the meantime, the government is also getting supportive. So if you take these two things into account, and US and China is about to sign the first phase deal, as we understand, on 15th of this month, I just do not see where the negative scenario is going to come from. So people will be surprised once again, as they were last year, and they will continue to buy. I do not see spike in oil price coming, as I've said before, given there's plenty of supply, and I just do not see Iranians getting into any overt war on Americans, because that will just destroy the Iranian economy, which is 45%, running at 40% inflation, and they have a massive negative GDP growth. So I just do not see an appetite. There will be guerrilla wars and proxy wars, but that has always happened. That's been going on for the last 10, 20 years.
Manish, thank you for sharing with us your outlook. Thanks so much as well, Kunal, for joining in, and Sudip for giving us your fundamental take. As we wind it up, let's hear it out from Sridhar Sivaram, who believes that investors should look for opportunities beyond the top 15 to 20 stocks. He says financials with strong fundamentals will continue to perform well.
If I just go back in the last 4 years and see all the tantrums that Trump has had with various countries, including North Korea and many of the others, they've had limited impact as far as the markets are concerned, because none of them actually really escalated. Keep in mind that this is an election year for the US markets. Yeah. They can't afford too many large negative news. So I would assume that these are the normal tantrums that you see just before election as far as US is concerned. We've seen this playbook before also. Markets reflecting a different story as far as the top 20 stocks are concerned. And you look at the broader market, many of them are, say, so we were looking at, the overall, say, 3,000 stocks that broadly trade. I think more than 50% of the stocks are down 60-65% from their peak. We may not see significant correction unless there is a bad news or significant bad news in many of them. If not, they could just see a time correction, and it could be that some of the the leaders for the next rally may be something completely different.